Hey guys, welcome to the Proving Ground Review. We're going to get started here in about 3 minutes. While we wait, Rachel is going to make an announcement, so hang out for that, and then we'll get started. Take it away, Rachel.
Thank you. Can everybody hear me okay? So welcome to the advanced class. Hopefully you guys all got the text reminder or an email about October 31st is going to be moved to Tuesday, October 30th here at the office. We're going to do the scary GPB. There we go. Great.
GBP.
There we go. I always mess that one up. And we're going to have a coach teaching on how to not be afraid of it because it's very wild. So if you want to learn how to do that, we'd love to have you guys. We're going to have a couple little contests and stuff. We give away a couple little prizes. And we're also going to feed you a really good dinner. I believe it's like Rubio's or somewhere really yummy. So we'd love to have you all come. And we'll still have our webinar. If you have any friends that want to get on, we have webinars that they can get on to see what we do here. So
it just won't be the Proving Ground Review. So the review is going to be canceled for the week of the 31st. So it'll just be, I think Matt Watts is doing the presentation, correct? Awesome.
So he's an executive coach, so it'll be really cool. Just a few things. We have some snacks out. Oh my goodness. We have some snacks out there in the hall. Turkeys, fruit, and some veggies if you're welcome to go get some. And I'll turn the time over to Hiram, okay?
Thanks, Rachel. All right. For those of you guys that are online, if you can let me know if you can see my screen and if you can hear me talking. Just got another minute here. We'll get started. If you guys can see my screen, hear me talking, go ahead and chat that in, please. Awesome. Thank you, John. Appreciate it. All right, guys, let's go to get started. Kenneth, and yeah, thank you. Good evening. All right, so tonight we're going to review the HEADFAKE. I was actually really excited about this because I kind of made some tweaks to HEADFAKE in preparation to roll it out for the alert. So a lot of times what we run into when we're creating an alert is we're trying to take, this program basically and have it read something that we see visually and basically write a code for it so that it, it reflects the same way in the code that it does visually for us. So things like the four-way, if you guys are familiar with the four-way or the whiplash or the hashtag, those are difficult because aesthetically we're looking at how the majors compare to the minors, which is very important in what we do, right? Because the majors are taking advantage of the minors in a lot of situations. So there's always, early on people beg the question, why do we even need the minors if we're trading with the majors? Well, we need the minors because a lot of times the majors are indicating what they're going to do next based on what the minors are doing as a reaction to what's happening in the market. So we need to be able to see what the minors are doing to determine how the majors are going to react to that, right? Because it's a zero-sum market or a zero-net market. That means that in order for someone to win, someone's got to lose. So by way, in the case of a bank who's got trillions and trillions of dollars and can push the market whatever direction they want, they need a lot of people to do one thing so that they can do the opposite, right? So if banks want to buy aggressively, then they need to get miners as a collective to sell, right? So imagine trying to orchestrate millions and millions of people to do the same thing against what you want to happen. Well, the best way to do that, obviously, is just to disseminate tons of information into the market and teach them exactly how to react to the market so that you know exactly what they're going to do and when they're going to do it and how they're going to react to certain types of market movement and positions so that as a bank you can do the opposite and take advantage of them. So that's why we always, we're always cognizant of what the majors and the minors are doing, not just the majors or just the minors. There are certain instances where we can pay attention to just one or the other. But for the most part, we want to see that dichotomy, right? We want to see what they're doing, how they're playing against each other. So with a head fake, that's essentially what we're doing. We're looking at how the minors have entered, the channel. Now, this is, of course, relative to their scale, which is another issue we run into, because the major scale and the minor scale are different. So you've got two different scales laid over each other, and we're looking at them as if they're working on the same scale, essentially. Because the major overbought doesn't really apply to the minors, it's not really relevant where the major overbought is, right? Generally, we'll see fatigue in the minors before even the majors achieve their overbought level. But with the head fake, essentially what we're doing is we're looking at the minors within their scale going into the channel and the majors relative to its scale remaining, in this case, oversold in this example right here. So when that happens, a lot of times what we're seeing is that the minors are convinced of one direction and the majors are planning on doing something completely opposite. And a lot of times it's quick and for just a small amount of pips, and other times it's much more aggressive, depending on the situation. Statistically, when we back test these head fakes, we find that they're in the 90s, right? So 90, I think it's almost 92%. It's like 91 point something percent accurate when we get all these parameters visible within the market for a desired amount of pips. Now, that desired amount of pips is based on it happening every single time. So obviously you're going to have certain situations where it may go 20, 30, 50 some odd pips, right? And other instances where it's only going to go, 5 to 7 pips, just enough to get you out of that particular trade. But when we backtest, it's indiscriminate of, the time, the volume, volatility in the market, all those things, right? And this is probably all stuff you guys have heard before. But the head fake is good for 5 pips. So the parameters are very similar to the hiccup, which we talked about last week. And generally, we teach them both at the same time because they're pretty simple to grasp together, mainly because two of the parameters are the exact same and the follow-ups are the exact same. And just so you know, the follow-up to the hiccup and the head fake are actually more accurate than the pattern itself. And by that, we mean that there are certain situations where you may have something that, let's say, is a hiccup, or in this case, a head fake, but one of the parameters is not present, in which case you wouldn't take the trade, right? You need all 4 parameters, and I'll explain what those are here in just a moment. But say you only have 3 out of the 4 parameters, and the trade still works out the way it would have had it been an actual head fake in this case. That follow-up, which I'll explain, is like in mid-90s accurate for at least 3 pips. And then the follow-up to that, which is usually a reactive trade, is also right in that range as well. They rarely ever miss, mainly because we've got a small pip count, but also there are instances where you're literally catching the beginning of a larger move long term. So let me explain, and then I just want to kind of preface with that, and then as I explain it, we'll kind of connect some of those dots. So I'm going to use this example first because it's one of the most common that we use. And if you watch any of the videos on head fake and hiccup, these are the examples you'll see. And I'll show you some other examples as well. So right here, you can see that we've got minors, which is our first parameter, our first variable. Minors have crossed, and to be safe, let's say they crossed one candle back and now are extended into the channel. So we've got minors crossed and entering the channel, right? And they're obviously in the channel. They're not leaning on the threshold. They're in the channel. The tip of the gray and black are all the way into the channel. Simultaneously, you also have the majors crossed, which early on, when you guys were light members, this would almost indicate a buy, right? That's kind of what the perception is until later you learn some of these nuances, and you realize, well, it's probably not going to be a very solid buy, if at all. So the second parameter is majors are also crossed and pointed up, but they're kind of lagging. You see how it's got a soft cross, they're hanging back, they haven't stretched up. You got separation between major and minor, right? It's kind of like that. It almost looks like a crescent wrench, if you know what a crescent wrench is. And then the third element is in pressure, and it's the same as the hiccup pattern. Green is on bottom when we're selling, and we are selling in this particular instance. And then green is on bottom of red. Again, it doesn't matter if they're pointed up or down. Green just needs to be on bottom of red, which gives us short-term bias in our favor. So long-term bias, can somebody give me an example of long-term bias on pressure? So just be the direction they're pointed. Long-term bias is the direction they're pointed. If they're pointed up, then you've got long-term bias to the long side, which is relative, right? Because if it's been that way for a while or there's separation, there's a lot of other nuances there. But generally speaking, if they're pointed up, you got more longer-term bias to the buy side than you do to the sell side. If you've got green on top, then regardless of which direction they're pointed, you have short-term bias to the buy side. If it's on bottom, you have long-term bias to the short side or the sell side. So imagine if you have both, right? You have green just popped on top of red and they're both pointed up. Now you have short and long-term bias in your favor. And then, of course, prior to that, you had what we call positive convergence. There's positive, yeah, we're not going to open up a whole, there's like a whole other can of worms there. Anyway, so, you know, if you're not sure, join the mastermind, watch some recorded videos, you'll be just fine. For now, let's just talk about the head fake. All right, so first element, minors are crossed that have entered the channel. Majors are also crossed, soft cross, right? They're hanging back, separation between major and minor. Green is on bottom when these are oversold, and we have what we call a contrary candle, and that means that if we're selling, we want a green candle. It's contrary to the direction we're going. So although this may look like a buy, and matter of fact, if you look at in this particular instance, and we don't consider the TNTs in this particular instance, but or in the pattern at all. But if you were, you could see that the thick orange is up, blue dotted is down, and thin orange, you have 3 out of 4 saying buy. You have major and minor both pointed up saying buy, and you have pressure pointed up. So that's at least 1 out of the 2 points saying buy. There's a lot here that's saying buy, right? But when you read this predictively, you're getting a completely different picture. So here we're going to sell. We're not going to go long. We're going to short. We're going to sell, and we're just going to go for 5 pips. And that went 16.7. Drawdown was about 2.4 pips. All right, so here's that follow-up that I was talking about. This is major, minor, both pointed down. So the first trade, although predictive, is considered a pattern-based trade. Why? Because that's just what I call it. So yeah, that's right. You're following a pattern. You're following a pattern with variables. So here, this is predictive. Right now, if we're counting this out, thick orange is down, which is sell. That's 1. Blue dotted is up in this particular instance, which is also sell. That's 2, right? Thin orange is down, which is a sell. That's 3 points out of 4 because blue dotted is down, which means up. So 3 out of 4 there. Major and minor are both down, so that's another 2 points. That's 6 right there. And pressure is down, and green's on bottom. So you got 8 out of 9 possible points, not 10 points. It's not a 10-point system. It's a 9-point system. Anyway, I'll leave that one alone. So we got a lot telling us sell, right? And a lot of times traders, you guys will do nothing in this particular instance because it's oversold, you know, but statistically we can actually get a buy out of that. That's what this is telling us, is that this is going to buy next. Statistically, that's what it's going to do, is it's going to buy. That's predictive, right? It's not reactive. Reactive is the direction they're pointing. Predictive, it's indiscriminate of which direction it's pointing. You just got to be able to read the indicator. And there's a lot of reason for that. We're seeing real-time information in the market. And last week we talked about the hiccup pattern. We kind of explained some of that, why this indicates a buy. So it's not the indicators are wrong. I mean, yes, the indicators are wrong sometimes. Yes, big surprise. Nothing's right 100% of the time, right? But in this instance, it's actually not that it's wrong. It's just that you're reading it incorrectly, right? And when you learn how to read it more aggressively, then you learn how to use it predictively, pattern-based, and reactively. So in this particular instance, we know a couple things. We know that 60 to 65% of the time, we're still going to get some sell. It's not always clear how much, even with technical analysis. But statistically, if you think about 60% of the time, that's still more than most of the time, right? That's 51% is technically most of the time, right? So 60 to 65% of the time is most of the time you're going to get some sell. So the advice here would be to look at your 5 minute for positioning, right? So what would we want to see, and go ahead and just shout it out if you guys know the answer. What would we want to see on a 5 minute? And just give me one example of what we would want to see in a 5 minute in order to justify positioning for this buy trade. Oversold. Yeah, major minor oversold, right? And not oversold and pointed up, guys. Oversold and probably pointed down, like hauling butt down. That's the best, right? As it's got like this 5 minute candle, right? Which is, you know, it's got this big red candle and it's worth like 2.6 pips. You know, but you've got this big red candle, right? Major minor just jammed and pointed down. That's a perfect opportunity to buy with something you're seeing on a 60 minute that's indicating long, right? Because now you're positioning, you're maxing out your 5 minute, right? So I'm not a fan, I'll tell you right now, I'm not a fan of waiting for the 5 minutes to roll and start to point up in your favor. You're going to miss a lot of your positioning right there, because that's reactively. What is it doing when it rolls and starts to point up? It's reacting to the market doing what? Moving up. There goes your positioning sometimes. If you've got a long-term, longer term, relatively, in this case 60-minute indication that the market is going to go long or buy, then all you want to see in the 5 minute is it short, right? And there's a couple examples of that. You know, at least 2 candles oversold with major minor double committed set pointed down, or at least 2 candles oversold with majors persisting down and minors kind of coming to a fatigue point, right, where it's kind of at a head, it hiccups, or it softens, kind of looks sideways. A lot of times if it crosses and goes the opposite direction, you might want to wait a couple more candles, because majors may continue to push down and then minors have to correct. A lot of that is dependent on what time. Okay, another can of worms. Let's move on. All right, so here we're looking for a long. We know that there could be some drawdown. Obviously use your 5 minute, but otherwise we're just looking for 3 pips or more in this particular instance. If we're just using the follow-up to the pattern and nothing more, not any other discipline, then we're just looking for 3 pips long. Oh, bam. We got some drawdown, 9.4, so it's about a 3-to-1 trade, and 7.6 pips long. And then usually after that, we get a reactive trade. Majors crossed up, minors crossed up, and we take another buy. And that's reactive, right? It's the direction they're pointed. Bam! I was waiting for it. 22.3 pips. So let's look at that. Let's look at another example here. So right here we have another example. This is a little tougher. This example is not as good in terms of its aesthetics. You can see that minors did cross the previous candle. They're in the channel, right? Majors are also crossed. Look at that soft cross again. We've got that separation between major and minor because majors are hanging back. Green again is on bottom. They're not I mean, minor green is pointed down. Red's kind of sideways. So again, it's not necessary that they point down. We just want green on bottom, short-term bias in our favor. In this case, we're selling, so we want short-term bias to the short side or the sell side. And then the fourth element is the contrary candle. Again, if we're selling, we want to see a green candle. In this case, we do have a green candle, and so we'd be looking to short. And again, just looking for that 5. If you're using other disciplines, which a lot of our mastermind members are doing, you're probably going to take more than 5 in a lot of these situations. And you're probably going to take a lot more than the 3 pips on both follow-ups. So altogether is a 5 pips down, and then 3 pips up, and then another 3 pip up, right, which is like 11 pips. So most of our guys are doing double that to the short side and sometimes quadruple that to the long side. So just keep that in mind. But if you're not instituting any other disciplines, you're just using the pattern, then it's 5 down. And then after that, wait till you get the follow-up set up, and then you take your long trade, and then your next long trade as long as you got all your follow-ups. So the next trade is which direction? Short, down, right? It almost feels unnatural just because these are pointed up, right? And that moved, bam! That moved 3.4 against, and then a whopping 36.1 in favor. Again, look at this. Major, minor, crossed, pointed down. Now, just a pro tip here. When majors cross and point down, that's intentional. They did that on purpose, right? When minors do it, they didn't have a choice. They got stopped out. All right, so understand that sometimes what you see in the majors doesn't apply to the minors. In this particular, this is a great example of that. Majors going from a cross up to a cross down, intentional. Minors going from a cross up to a cross down, forced by the majors, obviously. All right, so here again, this is predictive because we can see that these are pointed down. Pressure is down, solid, nice parallel. Green's on bottom, right? We got a nice red candle. And we can see that, I mean, if we tighten this up a little bit, I mean, it looks like, yeah, that's, we're following kind of that sequence, right? And now we're looking at some additional short. But we're smarter than that most of the time, Hiram. And so we want to go long here. We want to buy, yes, because these are pointed down after the fake out. So a fake out would be like a hiccup pattern is a fake out. A head fake is a fake out. A gray dagger is a fake out. Not as the gray dagger is definitely not as consistent as the hiccup and head fake, but gray dagger would be another fake out. Any of those that have this follow up where major and minor are oversold like this, without major having left, in this case the oversold, that's going to be indication of opposite movement. So right here we're looking for a buy, right? And of course just 3 pips. Unless you're using other disciplines, 1.7 pips of drawdown and 39 pips of upward movement. It's settled about 31.8 pips. And then look at this, again, reactive, right? Major, minor, cross pointed up. So then we take 3 up or 20. In that case, 20.7. Just depending on what you can justify, right? Okay, so that's our head fake. So you can see all the technical issues we run into when we want to try to code this, because it's not as simple as just reading a value like we do with the flat top. We're comparing the major and the minor, and then relative to their scales. I think I've kind of cracked the code a little bit, but not 100%. So let's look at some examples that are not as nice, but still work out, and sometimes don't have that follow-up either. So here's one where you've got minors cross. So the first element, in other words, the first thing you're looking for is that the minors on the previous candle crossed. So you see the cross, majors are not crossed, right? But majors didn't get their way here, right? They probably wanted minors to commit a little more. So majors had to release a little more lots, and then minors continued to buy. So you can see usually, obviously you want to have a green candle, so the minors feel like they're getting their way there. The first thing you're going to identify is that minors crossed in the previous candle and now they're in the channel. Are majors on the threshold or beyond, or are they sunk back? In this case, they're sunk back. This is a little more than a soft cross, but nonetheless, you can see soft cross, separation between major and minor. So that's your second element, is majors. Third is green on bottom. A lot of divergence there. Green's actually pointed up there, red's flat, but all we want is it to be on bottom, right? And then we've got a contrary candle. So what are we doing in this situation? We're going to short or sell, yeah. And we're going to only go for 5. Dinky little candle went 10.4. Yeah, no follow. It doesn't have the follow-up, right? So we leave it alone. If we're justifying a long trade after that, we're not using the follow-up sequence because it's not present. We're using something else. So don't just say, well, the head fake just happened, I'm going to buy, right? So it's not the way it works. And the reason I said that is because I knew that one was going to buy. Yeah. All right, so let's look at another one. I painted a few of them here just to kind of show you guys some rough examples, because I want you guys to see these, but this one's kind of on the border. I think that's why I marked it. You see that the black line of the minors, that's iffy. And rule of thumb, if you have to ask yourself, Is it in the channel or not? Err on the side of caution. Yeah, it's not. Err on the side of caution and just skip it. When it works out, or if it works out, you may kick yourself in the butt. Try not to, because if you're not comfortable with it and it's just not something that looks familiar to you, skip it. And no harm, no foul. It's better than just taking a chance on it and it eating your lunch, right? But here, minors crossed, may or may not have entered the channel. Did I say majors? Minors crossed, may or may not have entered the channel. Majors, there's that nice soft cross we're looking for, separation between major and minor. Obviously, minors had crossed on the previous post. Greens on bottom. This time they are pointed down, and we have a contrary candle. So we're looking for a sell there for 5, and we get 7.3. So that one's good as well. There are instances sometimes where that follow-up is elusive, because it'll like this, and I don't know for sure, but this shadow right here, if you guys know what a shadow is, like the opposite of a wick. The shadow right here, as that was forming, it's very plausible that major and minor were both crossed and pointed down. And then before the candle ended, it pulled up and it didn't really post that way for us, which is neither here nor there. It's fine. But again, no follow-up. And I think I have a couple in here that do have a follow-up sequence, but neither of these last two that we just looked at had it. And of course it bought. And then again. Don't reward yourself for bad behavior. All right. I had a couple of, oh, there we go. Good. I have a buy marked. Okay. So here again, kind of on the border, right? Gray and black. We've got previously crossed and now extended into the channel. Majors also soft cross, separation. Green's now on top, and we have a contrary candle. We have red candle. The only reason we're looking at the candle, by the way, is for positioning. That's it. And a lot of times, the larger the candle, the better, because you're going to get more of that push in the opposite direction. In this case, this candle is like 3 pips, right? From wick to shadow is like 6.5 pips. So we'd pretty much, on CCM, Capital City Market, we'd have to get most of that up. So we'd have to have a higher high, basically, to get out of this particular trade. But nonetheless, that's if we're using that, then we'd be looking for a long trade, buy trade. And again, that would be for 5. So you should not take the trade until in the channel. That's correct, John. You want to make sure that the gray and black are in the channel, below the threshold, or when they're overbought, or above the threshold of the oversold when they're oversold. So clearly in the channel. This is not as clear, which is why I kind of marked it. And so here that would be long, and we went 4.1, so not enough there. We only drew down about 1.4 pips, but 4.1 is not enough to get out of a 5-pip trade, even with what's the other one we use, Turnkey or FinPro. We don't have the follow-up here either, because minors are not overbought pointed up. So minors have to be overbought pointed up as well. And that one would have 12.9. So if we're going for 5 pips, we're using 5 to 1. When we test this, we're looking for like a 25 pip stopper. Let me clarify. It's not that I would recommend a 25 pip stop for a 5 pip trade, but we max out whatever we can possible with the alerts. But give me a break, guys. They perform at 90+%, right? So, so yeah, we use a 25 pip stopper. It's not the recommendation. Definitely use some other discipline to justify your stop or hedge position on any alert trade. So are we out of this one yet? No. Well, yeah, we are now, right? It went 16.1 against, then it went in favor, 11.9. So we would have taken profit. But the follow-up trade is dead because majors left the overbought. So no follow-up trade there. All right, let's look for our next setup. Anybody have any questions thus far? Yes.
Yeah, I'm just curious, like, are we looking at this pattern
3.
3. Okay, I thought it was 3, but I wasn't.
Mhm.
Sure. Okay.
No, it's a good question. So yeah, we're expecting to take so we're anticipating. Let's call it anticipating instead of expecting. The first trade, once that fills, then we're waiting for our follow-up. And the only way that sequence is nullified is, one, if the market does what you're expecting it to do without giving you the follow-up sequence, or 2, the majors in this particular case left the overbought, or if it's oversold, left the oversold. In other words, posted outside of the overbought or oversold. And then the follow-up sequence is dead. So you don't wait for it after that. But let's say hypothetically that the majors pulled up right here and the minors did not, but the majors have not left. So this is not a head fake, by the way. Can anybody tell me why? Yeah, absolutely. That's one. Crossing the same candle. What's the other thing? Pressure, right? Green's on bottom. We'd need it on top. But let's just say hypothetically this was one. If majors crossed and pointed up and minors did not, as long as majors don't leave the overbought and post outside of the overbought, then the sequence is still in place. So until both of those lines point up, preferably minors having resided overbought for at least one other candle, and then that's somewhere within that secondary candle agree with the majors pointed up, then that would be our opportunity to go the opposite direction, short. And then generally you're going to get the follow up there as well, where you got the reactive and both of them pointed down, and then you can short again.
And because this is over a 60-minute time period with the candles, it's like over 3 hours basically.
Yep, over 3 hours. Now here's the cool part. What if you walked into this after the first hour? It's not over for you, right?
Right.
You're waiting for the follow up sequence.
Yeah.
Or after the second hour, you're waiting for the third trade. So look at it in that perspective. Okay, I didn't get the opportunity to take that first one, but now here I am, and the second one setting up, or the third one setting up. And so what that's going to challenge you to do is when you open up your charts to analyze, you're going to snap back more than just one candle. If I'm just totally like oblivious to what the market is telling me, which is seldom, I'll go back as far as I have to until I recognize something. And sometimes it's upwards of like 6-7 candles on a 1 hour chart. And then I'll play it forward. Okay, generally this is what happens, right? What happened after that? And then I just kind of follow that sequence. And sometimes I'm like, okay, I would have called a short there. I'd be drawn down right now. And now it's absolutely ready to short. And all of a sudden it just makes sense. But I had to go like 6 or 7 candles back and then kind of walk myself through that sequence, right? So a lot of times they're really useful and helpful exercise to have if you feel like you're just guessing. Obviously, if you're guessing, don't take the trade unless it's in a throwaway demo account, not a focus demo account, and definitely not in a live scenario. But otherwise, if you need some clarity in the market, sometimes it helps to just kind of go back and see a sequence that you would consider familiar, and then just kind of play it forward and see if you can see where you are within that sequence. Somebody else have a question?
Oh yeah, the flashcards don't have any of the follow-on trades.
No, because if I added the follow-up, so I think I'm overly cautious sometimes, but if I added the follow-ups, then it would be expected as opposed to anticipated. I could.
We'll just do the homework.
Yeah, watch the videos. Absolutely. Right, we're not looking at that one because we know it's not what we're looking for. So there's other head fakes in here, but I have a couple of specific ones marked off. So they're few and far between. Did I catch all the questions? Anybody else have a question? Did I answer that question okay for you?
Yeah.
Oh, good. Okay. Oh, there we go. All right. So also, kind of on the border there, but also majors kind of stretched up a little bit. It's still kind of a soft cross, and it's hung back. We have that separation between major and minor. Minors are questionable, and you're not going to get a lot of help, by the way, in some of these situations by longer term charts. because sometimes the longer term charts are going to be indicating long, like in instances where we have the follow up, because that's sometimes going to be that direction for at least, sometimes multiple hours, 4, 6, 8 hours. Not always, but it's not likely that you're going to get a lot of validation from longer term charts whether or not this is going to be viable, this miner's kind of entering the channel or not, right? And the shorter term charts, just looking at this particular candle, those could be up in the air too, right? We could very well have the 5 minute oversold at that point because we had that pullback right here. So it's you may not get what you need in terms of additional validation to determine if that the miners are enough into the channel to justify the short trade or not. When we create the alert, I'll make sure that we're very clear, and so that you guys can tell because you received the alert that either the parameters were there or are still present, and that's really simple for the most part. Going either replaying that chart to see when the alert came in, if all the parameters were present, or if they kind of look like this, if it's going to be valid, right? So miners crossed entering the channel, majors also crossed, soft cross, hanging back, separation, green on bottom, and contrary candle. So we got a green candle when we're looking to short. We're looking for 5 pips to the short side. And we've got 9.2. Drawdown was only about 2.9, no follow-up trade. I know I've got some in here. Of course. I wish there was a skip button so you guys wouldn't see that. There's a lot of cause to go long or short in those situations, but you want to make sure that you're using some other discipline, not just saying, okay, I just had a head fake, now I'm going to go the other direction. This is actually not bad. This is actually a really good one. Miners crossed, entering the channel, clearly entering the channel. Majors, very soft cross, bless you. Very soft cross, lots of separation. You can see miners crossed in the previous post. So this is a nice clear indication. Actually, these are pointed down, which is a bonus, but we only need green to be on bottom, and we have a contrary candle. If the contrary candle is like a doji, do you guys know what a doji is? Where it ends the same, relatively close to the same place it starts, right? There's not a lot of body. It just looks like a cross, right? Like the body is just like a line, and then you got wick and shadow. If it's a green doji, it's just barely a contrary candle, and a lot of times you may want to, take pause in that situation as well. But a lot of bodies is usually nicer. In this particular instance, we don't have a lot. Nonetheless, the signal is good. So all 4 elements are present. We're looking for a short. Look at that, even when it's pretty. 5.3 to the long side, 1.2 to the short side. We're definitely not out of this. That one is 7.2 and only 1.9 in our favor. And we start rallying back to the short side, 1.5. Hiram's out by this point. I'm not waiting for 5 pips. I'm done. Yep, my 1 pip profit already took 2.7 there. And 5.8. Really? You're going to make me just keep on clear? Here we go. 11.4. Obviously, we didn't get any follow-up there. So even when it's pretty, sometimes it's going to make you work for it. See, let's find another one here. Yep. Okay, so ugly, right? Miners are not even over in the channel. You can see gray is barely, but the black is definitely on the threshold. It's not over above that line. Majors have that nice soft cross that we'd normally be looking for. We do have a separation between major and minor. Green is on bottom, and we have a contrary candle. So let's play this out and see how it works. That moved up 7.9, not even a pip in our favor. And then, of course, rewarded for bad behavior. So that would have that would have eventually filled. It only took 2 hours, but it definitely wasn't the setup we were looking for. Again, could you justify? I mean, is it even based on what you know? If you don't know a lot about the nuance of the indicators, does that really look like a healthy buy signal to you? Right? I mean, I'm selling on that sucker, right? Especially when you paint the whole picture. It just does not look like, especially from this point. Now, when that wick happened, it may have been more convincing, right? Because majors are probably up into the channel a little closer to the minors, but then before the end, it pulled back, which is why it's good to replay these charts sometimes, guys, because it gives you perspective. And it stops you from wanting to jump in and chase price, because you'll notice that once the indicators normalize after the post, then you're getting the true read. You can't read it as it's forming. It'll throw you for a loop. All right. Oh, there's one. This was actually really nice. Minors crossed, obviously entering the channel. Majors very soft cross. Can you guys even see that cross? It's so minuscule, like it's tiny. And again, if it's something that's questionable, you may want to skip it. That honestly, for me, that's preferable, as long as I can tell that green is on top of red and it crossed on top of red. And then green pressure on bottom and a contrary candle. So we'd be looking for a short or a sell, and it moves up 5.8, also gives us our profit, 12.6 to the short side. And again, likely, while this shadow right here, this thin part where when the market was down there, we could very well have had minors oversold pointed down and majors also pointed down, but just before the post it digressed and didn't give us our follow-up. So no follow-up, but of course it's going to do what it does. All right. All right, there's another one. This one's also rough, right? You can see that majors have more than just a soft cross. They're stretched up closer to the threshold. The minors are not even all the way into the channel in this instance. Black is still leaning on the, I mean, it's kind of questionable, I guess, but black is still leaning on the threshold. The gray is in, but the green and red are still kind of stretched up closer to the minors. Green pressure is on bottom. They're even pointed down in this instance. We got a contrary candle, but this is not as convincing, right? There's a push up, 13.6, 2.8 is all it went in our favor. Let's play this out, see how it goes. That's 33.7. Even with a 5-to-1, you got stopped out. That moved 4.8. So even if it moved down before it moved up, you got killed on that one, right? So I like to show you guys positive examples and then examples of ones that are questionable. And you'll see that you'll get mixed results. You'll get some of them work out, others won't. But that's the point, is that you don't want to get mixed results in your trading. You want to have consistent results. And so to have consistent results, you need to have consistent parameters. And maybe your parameters for trading don't consist of specific variables within, a 60-minute chart, but just overall. Like I know some guys are like, okay, I want my 15 to, be positioning. Well, my 60-minute is pointing up and my 240-minute is somewhere about in this range, right? Maybe kind of sideways or into the channel or whatever it may be. And then that's comfortable enough for them to take a trade. Whatever it may be, but whatever your rules are, just don't deviate from them. All right, so here's a really good example. Minors crossed entering the channel, clearly in the channel. So you guys can see that's clearly above the black and the gray are clearly above the threshold or beyond. Majors have that nice small soft cross separated from minors, hung back. Green is on bottom. It's ideal that they're also pointed down, but all we need is green to be on bottom. And we have a green candle. So we're looking for that short. And 9.2 and 9.8. So we got the same in both directions, but we took our trade. We took our profit. What's that? No follow-up. I know. I think I've got some in here that had follow-up, and I'm pretty sure it's like a crummy example. It's like, yeah, you probably wouldn't take this one, but guess what? There's a really nice follow-up, which is good because I want to show you guys that even if the parameters aren't there and it reacts the way it's supposed to, that follow-up is still valid. So the follow-up is not contingent on the first, on the pattern having all of its 4 parameters, and that's hiccup and head fake. You guys will notice that sometimes the major minor will make a hiccup, but minors are not touching the threshold or beyond, but everything else is there. And it still reacts the same way a lot of times. It's just not as consistent, which is why we don't use it. But it reacts the same way, and you get that follow-up, and that follow-up almost every time is going to work out. Almost every single time. It's really, really consistent. So I'm hoping we see kind of that, where we don't have a perfect head fake, but we get the follow-up. I know I have some examples in here that I marked. I marked a ton of them. So we don't have that soft cross, and you can see that the black is kind of on the threshold there, so it's not all the way extended in the channel. Green is on bottom. They're pointed down. That's good. Majors are not soft cross the way we would expect. There is that separation. We got a green candle. So, again, questionable. We probably wouldn't take this one as a head fake. If we were looking to short, it'd be for another reason, not because of the head fake. And that could have looked different as this wick was happening, but as it posted, it's just not, it doesn't meet the requirements, right? And of course, look at that. We were just talking about it. And of course, here's the follow-up, right? So right here, even though we didn't short on the previous, that went 4.6, then it went down 8.1. Even though we didn't short on the follow-up, or rather on the initial pattern, this follow-up is still going to be valid for at least 3 pips to the long side. And of course, we know 60 to 65% of the time we still get some drawdown, but there's our profit on our long trade, and it's within reason, right? 7.4 for a 3 pip trade. That's like a 2 to 1 trade, roughly a little more than 2 to 1, but with a 90+% accuracy, that's more than enough room. Obviously, because there's going to be a good likelihood of drawdown, you probably want to try to position it with your shorter term chart. So do we get that follow-up trade? Yeah. Do we try to take that initial? No. Do we have the next follow-up trade? No, because minor's not crossed and pointed up. Doesn't mean it's not going to buy. It just means it's not giving us the follow-up that we'd be looking for as a sequence to these trades. A lot of times what's cool is you've got a bootleg. Like if you don't get the follow-up trade, you usually get like a bootleg. Yeah, majors in one direction, minors the other direction, kind of that diamond look just before it. And it'll, but if you don't know what a bootleg is or how to trade it, then just stay away from it unless you've got all your other parameters. All right, let's find our next one here. Come on. Now you see why I got to make the background all nice and colorful, because otherwise it'd take forever to find the next one, one click at a time. I feel like we should have some like Jeopardy music or something right now. Oh, there we go. Okay, I like the soft crosses. Again, they're my favorite. Minors are definitely not doing what they're supposed to. They need to be in the channel. That's obviously not in the channel. Green pressure's down. We got a green candle, just barely, right? This is a really ugly, ugly setup in terms of a head fake. And a lot of times it's going to reflect in the trade as well. So that moved up 10.9. Yep, that little candle is 10.9 to that wick, and then 3.2 to the short side. So definitely not enough. Obviously, what comes next looks a little more appealing if it weren't for the fact that green's now starting to pop on top. But nonetheless, that's what we would have. I mean, had we executed, probably not going to be in a whole bunch of trouble. Yeah, it's still looking like it's it's good for a sell, but we got negative convergence. So we still get some of that up, 6.8. So from there, that was our highest point, 10.9, and then it came down 23.2 in our favor. Follow-up isn't there. Miners are not all the way oversold. Green did pop on top, so it's still likely we're going to get a buy now. But actually, look at that. Still went for a little short, 10.1. Yeah, look at that. Didn't give us much to the long side at all. That's pretty cool. Okay, let's go to our next one. Oh, good. A buy. Okay. So again, nice soft cross here. Again, questionable. So you got 5 in the first trade and 3 in the second trade. How much do you go for in the third? Joshua, you're going to go for another, well, based on just the pattern and the sequence, it's another 3 pips. So 5, 3 at 3. A lot of our guys are taking more than that. They're taking more in the initial when applicable, and then usually a lot more in the follow-up trades. Usually the follow-up trades are more valuable in terms of pip than the initial. So good question. Miners crossed entering the channel, but obviously it's questionable. Majors, nice little soft cross, a lot of separation. Green's on top, negative convergence, but green's on top, and they're actually kind of pointed up. So real quick, I'm just going to take a second and explain negative and positive convergence. So the rule when you first learn about the indicators is that if they're close to, if pressure is close together, if green and red are close together, and let's say they're pointed up, that's indication of strong movement up. Or green and red close together and pointed down, then that's strong movement pointed down. And they call that convergence. When they're separate, it's divergence, right? But I argue that there's a lot more nuance, and it's not really argument, it's just more insight into some of the nuance, and that's that you have, if green is already on top of red, and let's say they're parallel, they're not a lot of divergence, not very separated, but they look really nice and parallel, like some train tracks, and green's on top and they're pointed straight up. As green starts to lean into red, as it is here, that's convergence, right? It's coming closer to red. But that's not saying that the move that we're currently seeing is strengthening. A lot of times what that's saying is we're going to start seeing softening. And that doesn't mean we're going to start seeing other candles, other colors, but what it may mean is we'll start seeing more wick and shadow or smaller movements in that direction as we see that negative convergence, and then more wick and shadow and possibly reversal when green pops and posts below red, and same thing when it's pointed down, right? Now, if green is below red and pointed up, as it moves closer to red and ready to position point and get on top of the red, that's positive convergence, right? Because green is changing positions from being short-term bias to the short side and being short-term bias to the long side in combination with long-term bias to the long side because they're pointed up. That's why I always make that's why I you guys understand what I'm saying? That's why I point out the differences. How's that? Is because so there's negative convergence, positive convergence, short-term bias, long-term bias, because it illustrates the real value in pressure. And I said this a million times and I'll say it again. Pressure is not a trend indicator. It indicates trend. There's a difference, right? For it to be a pressure indicator, that's its primary job, is to indicate trend. But it's not. It's a feature of the pressure indicator. So it'd be like calling your car a flashlight because it has headlights, right? So you're devaluating it if that's all you're using it for. There's much more value there. And if that's all you use it for, it's not a terrible thing. It's fine, especially if it works for whatever your process is. But just know if you're ever curious, there's a lot more to it. So here, obviously, we wouldn't have another, again, we would have a questionable if a setup at all. And we end up getting 13.6 to the short side and 10.4 to the long side. So we actually would have filled that trade. But notice what happened to green. It popped on bottom, right? And so we started to see that, well, I mean, we'd already seen a red candle, but so that was more reactive, but it was negative convergence versus positive, even though they were both technically pointed up and green was on top. Notice that it also had been there for a while too. Okay. Let's see. I got about 2 minutes. See if I can find one more, and hopefully it has a follow-up to it. And then we'll wrap up. Actually, we're going to have an announcement just before we wrap up. He's going to find one more of the examples I was looking for. Oh, there we go. Okay. So that one's actually really nice. And we just, I mean, the negative convergence again, right? You see how green is on bottom, but now it's leaning into red, about to pop on top. But it still counts because green's technically still on bottom of red. This is again, could be questionable. And sometimes if I'm not sure, I'll just stretch it out as much as I can and validate. And then make sure to reset it to where it was. So minors are like overbought in this particular instance. Majors are very soft cross, oversold. Green is technically on bottom. Again, it could be questionable because it's, it's kind of almost touching red. If we stretch it out, you can see that it's obviously below red. And we have a contrary candle, so we'd be looking for a short for 5 pips. And we move up about 8. And we move down about 18.4. No follow-up trade, so no cigar there. That's going to wrap it up for us tonight, guys. I want to leave enough time for our ladies to make some announcements. If you guys have questions after the session, obviously go ahead and approach me. We'll get those questions answered. I also want to just extend an invitation to the mastermind. If you guys are curious about that, want to know what that's all about, send us an email, info@daytradesmart.com, and we'll send you some information on the mastermind. Thanks for joining us. Hang out for a second. For those of you that are online as well, I'm going to pass the mic to Darcy, and she's going to make an announcement. So my people hear better if you're closer to the laptop and if you speak into the mic loudly. Thank you.
All right. Is that okay?
Yeah.
Okay. You guys, just wanted to announce November 9th from 8 to 3. That is the trading competition that hopefully you've heard of already. That's from 8 to 3. And remember, if you refer 3 people, then you get your ticket for free to that event. So again, November 9th, 8 a.m. to 3 p.m. All right. Sounds good. Thank you.
Awesome. Thank you, Darcy. Appreciate it. All right, guys, that wraps it up. If you guys have any questions online, feel free to chat those in. I'll be posting this video hopefully tonight. If not, it'll be up tomorrow for mastermind members. And if you guys don't have any questions, we'll see you next week. Have a good one, guys. Thanks.